Hello, everyone, and welcome back to today's daily analysis. Today is Tuesday, the 21st May 2024. So, first, we're gonna do the analysis for dollar index for today. The dollar index has quite a quiet start to the week and is currently trading just above 104.5, with minimal changes despite recent weak data. As the financial conditions continue to ease, the Fed remains cautious about easing the policy prematurely. The US dollar, as measured by the US dollar index, edged for lower last week. The weakness was largely due to a pullback in the US Treasury yields, triggered by weaker than expected US Consumer Price Index data. The dismal CPI data revived optimism that a deflationary trend that started in late 2023 but stalled earlier this year has resumed. This has led traders to believe the Federal Reserve could start easing policy restrictions in the fall, putting downward pressure on the dollar, while sellers have taken advantage of the situation to ramp up bearish bets. The prospect of an easing Fed in the second half of the year, coupled with growing signs of economic fragility, suggests it will be difficult for US bond yields to continue higher. This removes an important driver of the dollar strength in the first quarter and suggests that further downside is possible in the near term. The US dollar index, a broad gauge of the US dollar performance, has partially recovered from its recent losses and found support near the intersection of the 200-day moving average at 104.35 and 104.25, 38.2% Fibonacci retracement level from 100.61 to 106.51. It ends in April this year. Further supports points can be watched at 104, market psychological level. The US dollar index currently faces direct resistance from the 50-day moving average 104.83 and 105.11, 23.6% Fibonacci retracement level. The main new information was the minutes of this week's Federal Open Market Committee meeting. This means that the foreign exchange markets may return to chasing high yielding currencies such as the US dollar. Next, we have the WTI spot crude oil, which briefly rose above $80 a barrel on Monday as risk appetite remained close to the surface, but upward momentum remained weak. WTI fell back to around $78.8 as appearance from Fed officials dampened risk appetite, limiting the buying pressure at the start of the new trading week. It was trading around $79.6 a barrel in Asia on Monday. Crude oil prices may be struggling after hawkish comments from Fed Reserve officials last week. WTI oil prices rose about 2% last week, driven by optimism about rising demand in the United States, the world's largest oil consumer. April inflation data showed US consumer inflation had eased back to 0.3%, raising expectations that the Federal Reserve could cut interest rates in 2024. Such rate cuts could spur economic growth and energy demand. Data from the US Energy Information Administration showed the US crude oil inventories fell by 2.508 million barrels in the week ended May 10, marking the second consecutive week of decline. In China, the industrial output rose 6.7% year on year in April, indicating a strong recovery in China's manufacturing sector and hinting at the potential for a stronger demand for the crude oil in the future. The daily chart here shows that the US WTI crude oil briefly broke above the 200-day moving average, 79.66 to 79.75 at the beginning of the week. WTI may be entering a consolidation zone this week between $78.81, 23.6% Fibonacci rebound from 87.08 to 76.34, and $81.71, 50% Fibonacci rebound. If it breaks through $80 and 81.71 this week, The next target will be 82.97. On the downside, we can focus on 78.87, which is 23.6% Fibonacci rebound level. The next level can be seen at $76.8, the central axis of the daily downward channel, and 76.34, the low of 15th of this month. Lastly, we have gold prices, which surged early this week and hit a record high of $2,450 as geopolitical tensions escalated. The gold price erased most of their daily gains but remained above $2,400 as sentiment improved modestly. The gold price strengthened in Asia on Monday, hitting a record high near $2,450.2 amid renewed hopes of a Fed Reserve interest rate cut and rising geopolitical tensions in the Middle East. Meanwhile, rising tensions between Russia and Ukraine, which launched attacks on each other over the weekend, have also fueled safe haven demand. A cautious approach or hawkish comments from the Fed officials on monetary policy could limit the precious metals upside. On the other hand, the People's Bank of China added 60,000 troy ounces of gold in April, making the 18th consecutive month of gold purchases, according to official data released last week. This supports the recent stability of gold prices. At the beginning of the week, the gold prices were trading on a positive side. Gold prices broke up out on the uptrend channel that has been in place since May 2. Technically, gold maintains its bullish outlook on the 4-hour chart as it trades above the 100-hour moving average 2440 and the 14-hour RSI, which remains above its midline around 82.5. Nonetheless, the overbought RSI conditions suggest that further consolidation cannot be ruled out before setting the stage for near-term rally in gold. The all-time high of 2,450 is immediate resistance for gold. A decisive break above this level would lead to a rally to the 2,500 psychological barrier and $2,526. On the other hand, the resistance turn support level at 2,415 will be gold's first downside target. Key competitive levels are at 2,400, the market's psychological threshold, followed by May 16 low of $2,370. And that is all for today's daily analysis. Thank you for watching and have a nice day.